Hello everyone, Brian here again. I'm the Manager of Treasury at First Calgary Financial, and this is your monthly economic update. Did you know that there is actually a stock market index that claims to measure the amount of fear that US equity market investors are feeling? Known as the VIX, it is the ticker symbol for the Chicago Board Options Exchange Market Volatility Index, which is a popular measure of the implied volatility of S&P 500 index options. Well, that's quite a lot to digest all at once. It is more commonly considered the investor's fear index or fear gauge and represents one important measure of the market's expectation of stock market volatility over the next 30-day period. So let's take something that appears difficult and make it simple to understand. First, what is volatility and why does it matter? Volatility is defined as the tendency to fluctuate sharply and regularly, and volatile markets are characterized by wild price swings with big up days followed by sudden sharp drops. Volatile market conditions make it extremely hard for traders and investors to decide if it's time to take profits or cut losses, as stocks could suddenly resume their bullishness and move up, or simply collapse and fall downwards. And what is implied volatility? It is simply the expected or forecasted volatility and represents the level of price volatility implied, in this case by the options market, and it is not the actual or historical volatility of the index itself. Before the introduction of the VIX in 1993, investors could only tell if the stock market was volatile or not through experience or by gut feel. The VIX literally quantified the concept of volatility, allowing traders to use it as an indicator or to simply trade or hedge against volatility directly. VIX is especially important in options trading because volatility can make or break certain option strategies. The VIX is quoted as a percentage and estimates the implied volatility of the market, which is the expected annualized movement of the S&P 500 over the next 30 days. Not to get too technical, but when the VIX is at 30%, it means that the S&P 500 might move as much as 2.5% over the next 30 days, which is simply 30% divided by 12 months. While there are other factors at work, in most cases the VIX starts to rise during times of financial stress and lessens as investors become complacent because it reflects investors' best predictions of near-term market volatility. High VIX readings mean investors see significant risk that the market will move sharply either upwards or downwards. Historically, this pattern in the relationship between the VIX and the behavior of the stock market has repeated itself in bull and bear cycles. If the VIX is riding under the 20% level, generally the market sentiment is good and well. But should the VIX move up over 30%, the market sentiment usually drifts towards unease and fear. When the US stock market entered a sharp correction in January of 2008, the VIX also spiked to a multi-year high of over 37%. Conversely, when the US stock market was at the height of its bull run in 2006, the VIX was as low as 8.6%, which again was a multi-year low. The correlation between the VIX and the state of the US equity markets has been quite uncanny. So next time, if you're wondering what kind of ride the stock market might be in for over the next 30 days, just check out the level of the VIX, which is available on numerous internet sites, and happy investing.